A must-read for Chinese investors, analysis of institutional flaws in China's securities market. China plunges into Great Depression, experts unveil truth of false prosperity. China's central bank cuts loan interest rate to spur property market, Chinese public skeptical. China's well-known chain supermarket Mart shuts down multiple stores. Lantern Festival sees spate of fires across China, high-rise building in Jiamusi engulfed. It's all covered in today's China Truths. A must-read for Chinese investors, analysis of institutional flaws in China's securities market. Around the time of the Chinese New Year, in an attempt to stabilize the faltering Chinese stock market, Beijing injected significant funds to bolster stock prices through its national team intervention. Simultaneously, it compelled exchanges to halt the selling of hedge funds and vocally announced its intent to severely crack down on malicious short selling. Despite various efforts, A-shares eventually rebounded, with the Shanghai Composite Index climbing back to the 3,000-point mark by the 23rd of the current month. On February 23rd, seasoned A-share investor Li Xiaomin informed Radio Free Asia that his losses for 2023 exceeded 2.8 million yuan, approximately $389,000. Throughout this period, he continually adjusted his mindset to remain rational, calculating the optimal time to exit. It wasn't until the market hit a new low on February 5th and rumors of government intervention surfaced that Li Xiaomin felt a sense of relief. Li was well aware of the situation, stating, "I'm fully aware, once the higher-ups convene and the New Year holiday passes, there will be a surge in prices. Just hold on, and nearly all inventory will be sold off. You can't predict the restrictions that might follow, so there's a possibility they won't allow selling." Li Xiaomin's sentiments resonate with many retail investors in China. Despite the stock market's continuous rebound around the Chinese New Year, numerous retail investors remain uncertain about the rally's sustainability. In contrast to the emotional perceptions of ordinary investors, experts possess a deeper understanding of the inherent issues within the Chinese stock market. Nicholas Spiro, a partner at the London-based macro and real estate consultancy Larissa Advisory, frankly stated that the stock market serves as the barometer of the economy, and the true issue behind the Chinese stock market's fluctuations is the loss of confidence and trust from the outside world in the government's ability to manage the economy. Many financial experts highlight that the Chinese securities market has harbored serious institutional flaws from its inception, which persist to this day. According to RFA, the Chinese securities market was established in 1990 with the initial aim of financing state-owned enterprises. Subsequently, a large number of private enterprises were permitted to go public, transforming the Chinese stock market into a financing platform. Kai Shinkuan, a financial blogger in the United States, unequivocally stated, "The Chinese stock market serves state-owned enterprises, not shareholders." Statistics indicate that out of the over 5,300 companies listed on the A-share market, nearly 1,500 are state-owned or centrally owned enterprises. As Chang Qing, one of the pioneers of China's futures market, emphasized at the 2022 China Capital Market Forum, state-owned enterprises do not abide by decisions made by the board of directors, but rather by those made by the party committee. Conversely, regarding the oversight of listed private enterprises, the two most criticized money-making mechanisms in China are the IPO and quantitative trading. These systems allow enterprises and investment institutions to exploit retail investors' funds recklessly, leading to the stock market's endless decline. Quantitative trading has notably adversely impacted the Chinese stock market but remains unaddressed. Originally, quantitative trading referred to financial institutions utilizing extensive data analysis and pre-programmed model algorithms to automate stock trading, thereby enhancing trading efficiency. In March 2022, when Professor He Chang from the School of Finance of Central University of Finance and Economics criticized the significant issues of quantitative trading in the Chinese stock market, he highlighted that since the primary investors in the European and American markets are institutions rather than retail investors, quantitative trading is extensively utilized in these markets. However, the Chinese stock market operates in a completely different manner, with retail investors comprising the main demographic. Many retail investors lack access to quantitative trading, rendering it highly unjust for those excluded from utilizing this tool. In response, Professor Yi once called on the Securities Regulatory Commission to enhance supervision and limit the use of quantitative trading. However, the Securities Regulatory Commission responded slowly, likely due to pressure from institutional entities. Furthermore, China's IPO system for enterprises presents another institutional flaw in the Chinese stock market. Following the Securities Regulatory Commission's transition of the IPO process from an approval-based system to a registration-based system on February 17, 2023, peculiar occurrences arose where companies engaged in short selling immediately upon their listing. An illustrative example is the case of Golden Emperor Company, which engaged in margin trading to sell 4.7 million shares on the day of its public debut in September 2023. It's evident that these companies went public primarily to liquidate their holdings, resulting in a direct impact on stock prices. Hence, He Chang emphasized, this is the reason behind the continuous decline in the Northern Exchange. During the Financial China 2023 conference on December 2, 2023, Liu Jipeng, the chief expert of the National Social Science Fund Major Project, delivered a keynote speech titled Transformation of the Capital Market. He candidly described China's capital market as characterized by unfair wealth distribution and a lack of justice, with A-shares remaining stagnant around the 3,000-point mark for an extended period. The root cause lies in our systemic issues, necessitating fresh reforms in securities regulatory frameworks. However, shortly after publicly criticizing the Chinese stock market, Liu Jipeng faced a complete ban from mainland China's network and was compelled to resign from his position as Dean of the Capital Finance Research Institute at China University of Political Science and Law. China plunges into Great Depression, experts unveil truth of false prosperity. The CCP's Ministry of Culture and Tourism's data center recently released figures indicating 474 million domestic tourist trips during the New Year holiday, with domestic tourists spending 6.32687 trillion yuan, approximately $878 billion US dollars. Key national retail and catering enterprises reported an 8.5% year-on-year sales increase based on comparable metrics. CCP state media highlighted New Year consumption data, including tourism, dining, goods, transportation, and movies, as evidence of a strong start for the Chinese economy. Despite the CCP's relaxation of pandemic restrictions in 2023, China's industries saw a downturn, with declining exports, sluggish domestic demand growth, notable drops in manufacturing production and sales, a precarious real estate sector, and other indicators of economic decline. Renowned mainland financial influencer Big Lu Shua recently posted a video acknowledging the holiday consumption rebound but emphasized the presence of false prosperity. Beneath the billions spent lies a contraction in trillions of spending, a phenomenon known as lipstick economics. This trend refers to the surge in lipstick sales during economic downturns, also called the preference for low-cost products trend. He asserted that regardless of financial status, if individuals spend within their means to enhance their lives, all Chinese citizens can contribute to stimulating the consumption market. Thus, any domestic consumption facilitates wealth circulation within the country. Once money circulates, some will inevitably reach those in need. However, if money stops circulating, it spells trouble. Big Lu Shua emphasized the crucial importance of consumer recovery within China's current context, noting the irreversible trend of decoupling traditional economic ties between the West and China. He urged Chinese citizens not to harbor illusions about this reality. From this perspective, stimulating domestic consumption takes on significant importance. This month, Voice of America published an article by a Shanghai political scholar under the pen name Jiang Feng, titled The Great Depression is Here, a Historic Moment of Shanghaiization. The article describes the unsettling atmosphere preceding the 2024 Chinese New Year, akin to the onset of an unprecedented Great Depression. Chinese people are helplessly witnessing this dire economic situation, with more businesses and factories closing early or taking holiday breaks before the New Year than ever before. This widespread economic downturn and bosses fleeing have become almost commonplace. The article suggests that an inward-focused economy dominated by power rather than the market is gaining prominence in China. Over the past decade, China has experienced fundamental and comprehensive destruction, leading to a direct undermining of the Chinese economy and even Chinese politics. This trend serves as the root cause of China's pessimistic political landscape and inevitably leads to a Great Depression. Financial experts: trust crisis spurs 3 major capital surpluses. In a recent statement, financial influencer Magical Bruce highlighted that the foremost challenge confronting the Chinese population currently is the trio of capital surpluses stemming from a lack of trust. He explained, the first surplus is an industrial capital. China's manufacturing sector is facing widespread surplus, with many industries operating well below full capacity, some as low as 20%. This surplus is aggravated by insufficient demand and a lack of purchasing power among consumers, leading to excess inventory. Apart from a few sectors yet to undergo deregulation, surplus capacity pervades. Diminished orders and profits prompt the exit of foreign investment and a rise in unemployment, further fueling the surplus. The second surplus is in financial capital. Many banks find themselves with more deposits than loans, as businesses refrain from investing and consumers curb spending. Consequently, this capital remains trapped within the financial system, failing to stimulate the real economy. Banks struggle to lend out funds while still obligated to pay interest, resulting in an overabundance of financial capital. The third surplus is in commercial capital. Shopping malls, pharmacies, hotels, and milk tea shops are now ubiquitous. In 2012, there were 420,000 pharmacies, a number that ballooned to 620,000 by the end of 2022. It's common to find 4 to 5 pharmacies lining every street. Sacked on first day back to work. As previously reported, across various social media platforms, numerous users aired grievances about the widespread economic downturn they observed, citing closures of businesses, bankruptcies, plummeting property values, unemployment, and significant losses in the stock market. One of these users is Yuzhou Erlong from Hunan Province. He recently posted a video revealing that on the first day back to work after the Chinese New Year holiday, he was unexpectedly laid off. He didn't want to disclose this to his family. Despite spending 2 days job hunting and applying to 3 places, he declined all offers due to low pay and limited growth prospects. Now homeless and uncertain about his future job, he's been sleeping in his car for 3 consecutive days, waking up frozen each morning. He also bemoaned the fierce competition in job hunting, with 45 applicants vying for a single position. Finding employment in 2024 proved exceedingly challenging, with few job openings and an abundance of job seekers. Even graduates from esteemed universities competed for positions alongside middle-aged individuals like himself, intensifying the job search. In a recent video, Qi Tian, certified as the general manager of Beijing Oriental Jingjia Technology Company, Limited, recounted witnessing an elderly lady rummaging through a trash can for an extended period. When asked, she explained that she saw empty bottles to sell. Her son was getting married and had a mortgage to pay off, so she collected bottles to ease the financial burden. Qi Tian noted the grim reality that impoverished individuals were already depleted of energy simply trying to survive. China's central bank cuts loan interest rate to spur property market, Chinese public skeptical. In a bid to stimulate the sluggish economy, the CCP's central bank recently made a significant move by lowering the long-term loan prime rate, LPR, to a historic low, aiming to revitalize the property market. In detail, on February 20th, it announced a 25 basis point reduction in the LPR for loans with a maturity exceeding 5 years, bringing it down to 3.95%. However, the Chinese public who have just experienced a stock market crash are skeptical about the cut and remain reluctant to invest in the real estate sector. Xia Yifeng, president of the China Urban Real Estate Research Institute, said that this is an unprecedented rescue move and indicates that the property market may be about to usher in a new turning point. Zhang Dawei, chief analyst of Zhongyuan Property in China, said that this interest rate cut will have a significant impact on the real estate market, especially in first and second-tier cities. He predicted that mortgage interest rates will remain at historic lows over the next 3 years. However, the Chinese public believe that these so-called experts are royal experts who collaborate with and speak out for special interest groups within the CCP. They express distrust, stating, if people continue not to buy houses, the government will further cut loan interest rates. Meanwhile, other voices, like entrepreneur Chao Diwang's, caution against excessive mortgage debt, warning of a potential real estate bubble burst. Netizen Kaikangzu posted a video on social media on February 21, saying that the cut in mortgage interest rates now is a negative for most people. He pointed out that as loan interest rates decrease, corresponding bank deposit interest rates also decrease. According to him, the government continues to print money while lowering deposit interest rates, and the wealth of ordinary people shrinks faster. Moreover, we are not in a period of economic growth, and it is impossible for most people to make up for the shrinkage of their wealth by working. I'm quite panicked. Wang Guochen, assistant researcher at the Tsinghua Institution for Economic Research in Taiwan, said on February 22 that this loan interest rate cut is related to China's stock market crash. The CCP hopes that through the cut in mortgage interest rates, real estate consumption or home purchases will increase. However, the data is that many real estate sales in January were basically in decline. It's a continuation of a recession. The pessimism of real estate also suppresses the ability of the entire Chinese stock market to rebound significantly, so they use this method to stimulate real estate and also hope to stimulate the entire stock market. As for the effect, Mr. Wang said that he thinks the effect will be minimal. Everyone is afraid to buy a property. Whether it's Evergrande or Country Garden, quite a few new top 50 property developers last year fell into debt defaults, including state-owned real estate enterprises. The reduction of LPR will not be able to reverse the entire real estate debt. Naturally, the debt cannot be resolved, so he thinks the subsequent real estate market will be worrisome. China's well-known chain supermarket Mart shuts down multiple stores. China's sluggish economy and low consumer confidence have prompted Mart, a prominent chain supermarket, to close its stores in Dayang, Sichuan, Zhenjiang, Jiangsu, and Zhuzhou, Hunan Province. These stores, operating for 9 to 10 years, have shut down without given reasons. Since January 2023, at least 13 Mart stores have closed or announced closure, mainly due to lease expirations and operational adjustments. Notably, the Panzihua store in Sichuan, opened in late 2018, closed after just 4 years. Mart, a subsidiary of Gaoxin Retail Company, Limited, operates hypermarkets, supermarkets, and convenience stores. In the midterm report for fiscal year 2023, Gaoxin Retail reported a revenue of 35.768 billion yuan, nearly $5 billion, marking an 11.9% year-on-year decrease. The net loss attributable to the parent company was 378 million yuan, about $52.5 billion, a significant 334.5% increase compared to the previous year. Gaoxin Retail attributed the loss to factors such as a contraction in the supply chain business, lower than expected performance, and increased discount promotions, leading to a decline in sales profits. Lantern Festival sees spate of fires across China, high-rise building in Jiamusi engulfed. During the 2024 Lantern Festival, fires broke out in at least 3 mainland Chinese cities. Notably, videos surfaced on February 24 showing a high-rise residential building ablaze in Jiamusi City, Heilongjiang Province. Flames quickly spread from the first floor to the 17th floor rooftop of the same unit, forming a towering fire dragon. Reports indicate that the fire originated in a unit of the high-rise residential building in Sanjiang Commercial City. Local authorities claim the fire was extinguished with no casualties, though this has been questioned. On the same night, videos circulated online showing a major fire at a toy store in Shenzhen's Longhua Market, Guangdong Province. Official reports on casualties and financial losses are still pending. Earlier that day, videos emerged allegedly showing a residential building on fire in Shuajia District, Ningbo City, Zhejiang Province. This incident also awaits official confirmation. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.